What's going on? Welcome back to the channel. So today we're going to talk to you about Chart Industries. I want to go over the recently submitted earnings, give you the absolute key highlights from those earnings, some general support and resistance points, and what analysts are saying. Before we get into any of that, make sure you hit that thumbs up, and with that, let's get right to it. So sitting at $190.55, it did go up 4.55% on Friday. Over the last 1 year, it did go up 29.03, and then over the last 6 months, up 57.83. So doing pretty good in that capacity. Seasonality, March seems to be, over the last 10 years on average, negative 0.6, but April and then leading into June and then as well July, those seem to be some pretty kick-ass months. So up 6%, 5.5 or 5.7, and then 11.3. Aside from that though, their earnings wasn't all that great, so they did miss on earnings per share as well as revenue. Later in the video, I'll go over the future guidance, but they did miss on revenue by 59.21 million. The implied move going into the earnings was 12.26%. So the earnings was rather timid, if that kind of makes sense, but there wasn't that much expectations leading into the earnings. So the 2 weeks, 1 week, 3 day, and 1 day leading into the earnings wasn't all that great. But it's kind of funny though. I normally do my pre-analysis videos where I give estimates on where I see things going for earnings. If you look at this column right here, the 1 day, they beat basically 90% of the time. So I think the writing was on the wall that they were going to obviously do fairly good. Might not necessarily be always just based on the key metrics, earnings per share or revenue, but if a company does give overwhelming good future guidance, that will kind of be more important to the market than, for instance, earnings per share and so forth. But as far as the options that was done on Friday, there's a consensus for it to be roughly around that $200 range by March 21st, 2025. Bears on the flip side, they are anticipating mostly for it to be sub 210. So there's not much options activity for the bears to really analyze all that much. But looking as far as shorts, 11.1% of the free float is being shorted. Works out to be 4.64 million shares. This isn't a squeeze play on a side note, but based on this and what shorts were doing leading into the earnings, they were returning. So this leads me to believe that they did know that this was going to be a pretty good earnings in some capacity, or else there was no real justified reason for them to really be returning leading into the earnings. So yeah, kind of interesting for that. With it closing at $190, like I mentioned, it is trading between this S1 and this S2. So 192.79 will be that next strong target slash resistance, followed by 205. Flip side 184 and then 171 is going to be the next strong kind of support points. So let me know your thoughts on that. Regarding analyst ratings, you did only have one that was done by TD Cowen, Mark, who has a 40% success rating, so not all that great, but did give a buy $205 price target. So as a consensus, $217.33 is that price target or consensus, and that does represent a 14.05% upside. So let me know your general thoughts on this stock. Are you a buyer? Are you a seller? What's your general takeaway from all that? And then with that said, let's get right to pretty much the future guidance. So again, give yourself a shout out if you do currently own it and whatever else. But with that said, let's get right to it.
Chart Industries sees $24 billion pipeline and reiterates 2025 growth targets. Earnings call insights Chart Industries, GTLS Q4 2024 management view. CEO 𝗖𝗢𝗡𝗡𝗘𝗖𝗧 highlighted the company's strong cash flow performance, generating $281.5 million in net cash from operating activities for the quarter, contributing to a full-year free cash flow of $388 million. These funds were utilized to reduce net debt, achieving a year-end net leverage ratio of 2.8x, progressing toward the target range of 2x to 2.5x by 2025. Orders for Q4 reached $1.55 billion, driven by a 29.4% year-over-year increase. Key contributors included the Woodside LNG Phase 1 order and additional awards in nitrogen rejection units, hydrogen, and space exploration. The company noted its best-ever order year for hydrogen in Europe and record hydrogen sales in Q4. CFO Joe Brinkman emphasized that Q4 adjusted operating income reached $243.4 million, reflecting a 22% adjusted operating margin. Adjusted EBITDA stood at $283.6 million, contributing to a full-year total of $1.014 billion. or 24.4% of sales. The company reiterated its medium-term gross margin target in the mid-30% range, supported by improved operational efficiencies and synergies outlook. Chart Industries reaffirmed its 2025 revenue guidance of $4.65 billion to $4.85 billion and adjusted EBITDA guidance of $1.17 billion to $1.225 billion. Free cash flow is expected to range between $550 million and $600 million. CEO of 𝗲𝗡𝗡𝗘𝗖𝗧 noted that the 2025 outlook is supported by a strong backlog, including the Woodside LNG Phase 1 order. The company's commercial pipeline has expanded to approximately $24 billion, with $2 billion in customer commitments outside the backlog. Management anticipates growth across all four segments in 2025, with LNG sales expected to increase, driven by backlog and new project conversions. Financial results. Q4 sales reached $1.1 billion, marking a 10.8% increase year over year and contributing to a full-year organic sales growth of 16.9%. Adjusted diluted EPS for Q4 was 𝗖𝗎𝗧𝗪, impacted by foreign exchange headwinds, tax rate changes, and higher interest expenses. Adjusted operating margin for the year increased by 400 basis points to 21.1%. Specialty product sales surged 47.7% year over year in Q4, driven by carbon capture, hydrogen, and space exploration. Gross margin for this segment was affected by startup inefficiencies at the Theodore, Alabama facility. Q&A. Saurabh Pant, Bank of America, asked about segment-level growth expectations for 2025. CEO of 𝗲𝗡𝗡𝗘𝗖𝗧 confirmed growth across all segments, with LNG and carbon capture driving HTS and specialty, respectively. She emphasized improving backlog conversion as a key driver. Ben Nolan, Stifel, inquired about improvements in cryotank solutions, CTS. CEO of 𝗲𝗡𝗡𝗘𝗖𝗧 noted a strong start to Q1 2025 and emphasized the company's diversified supply chain to mitigate risks in China. Scott Gruber, Citigroup, questioned the growth outlook for aftermarket in 2025. CEO of 𝗲𝗡𝗡𝗖𝗧 highlighted visibility into long-term service agreements, LTSAs, and framework agreements as key contributors to high single-digit growth. Manav Gupta, UBS, asked about factors influencing free cash flow guidance. CFO Brinkman cited EBITDA conversion, normalized CapEx, and backlog conversion as primary drivers. Mark Bianchi, TD Cowen, discussed LNG order contributions. CEO of 𝗲𝗡𝗡𝗖𝗧 indicated that LNG-related orders represented approximately 20%-25% of 2024 orders and could remain consistent in 2025, with potential upside from an expanding pipeline. Sentiment analysis. Analysts expressed optimism regarding the company's order growth, backlog visibility, and execution capabilities, with an emphasis on LNG and hydrogen markets. Questions reflected keen interest in segment-specific growth and backlog conversion. Management maintained a confident tone, particularly during prepared remarks. CEO of 𝗲𝗡𝗡𝗖𝗧 frequently referenced operational improvements and a growing project pipeline to reinforce the company's strategic positioning. Compared to the previous quarter, both analysts and management showed increased focus on the LNG and hydrogen segments, reflecting a shift in market dynamics, quarter-over-quarter comparison. Q4 orders of $1.55 billion marked a significant increase from Q3's $1.17 billion, driven by the Woodside LNG Phase 1 project. Sales also grew sequentially, maintaining consistent momentum across all segments. Management's tone remained positive, with greater emphasis on hydrogen and LNG opportunities compared to Q3. Analysts showed heightened interest in the company's ability to execute large-scale projects, particularly in LNG and specialty products. Risks and concerns. Management flagged foreign exchange as a headwind, with potential impacts on 2025 sales if current rates persist. Startup inefficiencies at the Theodore facility affected specialty products margins, but management emphasized that these issues are not expected to recur. Analysts raised concerns about timing and conversion of large orders, particularly in LNG and carbon capture, which could impact revenue realization. Final takeaway. Chart Industries delivered strong Q4 results, driven by record orders and operational improvements. The company reiterated its 2025 growth targets, supported by a robust backlog and expanding project pipeline. Key growth areas include LNG, hydrogen, and space exploration. bolstered by increasing adoption of proprietary technologies like IPSMR. Management's focus on backlog conversion, cash generation, and operational synergies positions the company for continued growth, while analysts maintain a watchful eye on execution risks and market dynamics.